Hey everybody, so today I'm going to talk about something that's a little bit different that was in the original run of the Beer Money Engine experiment. Now, we all love earning apps like Bridge Money, Atlas Earth, OnePulse, Amazon MTurk, and I'm sure you all have a favorite. But some of us would like to take that money and try to make more money. So how do we do that? Well, we can do that in a couple ways. And one of those ways could be buying premium memberships for an app like Bridge Earn Plus or the Atlas Earth Explorer Club, especially if you're a newbie. But for those that want something a little bit more, let's just say, involving interest and no effort whatsoever, there are investments out there like stocks, bonds, and CDs. Now, one of those investments I'm talking about here that got really popular when this channel started was I-bonds from Treasury Direct, and that's what I'm going to talk about today. So what are I-bonds? I-bonds are inflation-protected bonds from the U.S. Treasury. The full name for them are Series I savings bonds, and they have their interest rates directly tied to inflation. To get them, there is only one place to get them from, and that is, well, treasurydirect.gov, and you need to be a U.S. citizen, U.S. resident, or a civilian employee of the U.S. government. Now, the interest rate will change every 6 months, May and November of each year, and you can buy up to $10,000 worth of bonds in a year in no less than $25 increments. However, you can set up additional methods if you want to contribute more. Once you contribute, you aren't allowed to take out the money for at least 1 year, and if you take out the money within 5 years, you surrender the last 3 months of interest. Otherwise, these bonds mature for up to 30 years, but I'm pretty sure that a lot of people will get their money out long before that. Now, as far as getting the value of a bond, Treasury Direct already sets the value for you regarding getting rid of the last 3 months of interest. And then after 5 years, they just tack on 3 more months of interest is basically all that they do the last 3 months. Now, when you buy the bond, regardless of when you buy it in the month, you get the interest rate for that month, and you do get 6 months of that current interest rate that you buy it on, regardless of when you buy it. So, say that you buy it in November, then you'll receive that interest rate from November till May, or April, I should say. May 1st would be the last day. Now, if you buy it in February, you will receive the locked-in interest rate until August, despite the new interest rate is posted in May. There's a very popular optimal strategy for buying I-bonds where you only buy them on the last week of April or October if you want to lock in that interest rates for 6 months before the interest rate falls. And then the third best month to buy is usually December, which is shortly after Christmas, and that's if you're trying to max out for your calendar year and you came upon a windfall of some sort. And yes, on rare occasions, you don't have to just use I-bonds to match inflation, but to beat inflation. One of those ways is during times of deflation. Now, if the inflation rate falls below 0 at any time, and I believe that's also adding on the fixed rate as well, and we'll talk about the fixed rate in a bit, I-bonds are guaranteed to remain at a minimum of 0%. So you won't lose money, but your money could end up being worth more because of deflation. There's only been a handful of times in my life, though, where the 6-month inflation rate was negative, but I think this is still a pretty useful thing. The second way to beat inflation is to buy them when they have a fixed rate that's higher than 0. So, for example, on May 2023, the inflation rate posted was 4.3%, but that included a fixed rate of 0.9% of said I-bonds. So if the inflation rate ever hits 7%, for example, and you bought this I-bond today, then you add 0.9% fixed to that, and you would get 7.9% interest on that 6-month period. So basically, I-bonds is kind of a best of both worlds situation. There's a shield in the bottom and a shield as inflation rises. Now, this is overall inflation and not inflation of necessities that these days seem to always rise higher than the overall inflation, but it still provides even protection from that. And honestly, as far as savings goes, it's been my favorite guarantee for any savings, not just beer money, but for just savings in general. Of course, if I wasn't paying down a mortgage. I just also only wish that I could have put more than $10,000 in a year, and that would have definitely helped me out a lot. Now, I bonds were in its heyday around last year in 2022, parking at about 9.62%. And I think you all remember that from a video that I had in the original experiment, if you're an old-time listener of this channel, an old-time watcher of this channel, I should say as well. Look, I just show screens. I'm not showing myself on video, so I'm sure some of you are listening as well. So, by the way, for those of you that are listening and watching, thank you. They have dropped considerably since, though, and the current posted interest rate as of November 1st is at 5.27%. However, 1.3% of that is the fixed rate. That is the highest fixed rate for I bonds since May 2007 and tied for the second highest fixed rate for I bonds in the last 20 years. They have also passed the interest rates of just about every top savings account out there, including the 5% from Bridge Earn and almost all CDs and money markets. If you had such a bond during May of last year when rates were 9.62%, you were going to get a 10.92% interest rate, which honestly was even better than stocks many years. One of my favorite uses for the I bonds has been to be used as a second line of defense in my emergency fund, and I usually will keep about 2 to 3 months in my first line as a savings or checking account, or in a rare case, a CD. Then I will take another 3 to 6 months worth of living expenses and lock it into I bonds. With as much as things cost these days, though, and being only allowed a limit of $10,000 a year in I bonds, it does take a good few years to get that second line going, though. If you're in a position that you're not trying to pay down a car or house, this honestly would be a good time to get I bonds for the next decade or two, in my opinion, in case we ever get an inflation rate like we did last year. Now, I will say that this is just me thinking out loud. I'm talking my own strategy. Obviously, don't take what I say as actual financial advice, but I do want to show with this very crude calculator just how far an I bond can go. Now, I went ahead and I took every I bond interest rate on treasurydirect.gov going back to November 1998. And you can see here, these are the semi-annual interest rates here. These are the semi-annual inflation rates, I should say, that they gave. So if you just combine the two, then you would get yourself the annual rate for that point. I think they usually go by the May and November one. So if I combine these two, you will see here the sum over here that the interest rate for that year, they had put it in at 2.62%. And what I'm going to do is I'm going to input a $10,000 I bond here and see how far it would have gone based on the fixed rate. So I'm going to go with $10,000. And just with no fixed rate, if you had bought during the height of the inflation days, the 9.62 one, which would be down here, you remember the 4.81% and the 3.24% as well, also quite high. You see that with no fixed rate whatsoever over a 25-year period, we have $19,678 after 25 years. Now, you're not going to make stock money out of this. Almost doubling your money after 25 years is not too bad, in my opinion. You probably might have done better with a double E, because I believe the class double E savings bonds automatically double after 20 years regardless of the interest rate. So if you were planning on getting a long term, then yeah, the double E was probably a better option. However, let's increase the fixed rate. I'm going to use today's fixed rate of 1.3%. So if I go with 1.3% instead, we'll talk about what they actually got in a little bit, but if you do today's fixed rate, and let's just say this is kind of how it follows over the next 25 years, then you will see that come November, 25 years from now, I should say, you'll be making $26,915.12, almost tripling. That's like a 40-50% increase, which is not too bad, but I'm going to tell you that the fixed rate in November 1998 was actually 3.3%. And so a $10,000 I bond back then would be worth today $43,773.56. That is over quadruple what what you would normally get, which actually does kind of compete with stocks a little bit. I'd have to check the calculations here to see if you put $10,000 in the S&P 500, how much you would make. So give me one moment. Okay, looks like I found something here where I have an S&P 500 calculator, historical return with dividends. Let's go ahead and set this up. We're going to put November 1998. And I'm pretty sure the stocks are going to win out, but I'd want to see by how much. And remember, this is the ups and the downs, though. And we'll talk about what it would look like in afterwards. So I'm going to do $10,000 here. We're going to calculate. Does it not work? Invalid month selection. Okay, so I had to make a couple fixes here. Apparently, I forgot. It's November 2023, so right now, if you click on November 2023 here, it's going to leave an invalid month selection. Data does not exist for these dates. They only have everything up to September, so I'm taking the September 2023 one on this one, and what we got, let's do September 1998 instead, is the investment grew to $44,244.49, which means that if we go based off of that, it is very comparable to stocks at the time. However, this is without the dividends reinvested, which if I remember during the time of the 90s, it wasn't very easy to reinvest your dividends into the stock market at the time. There was, drip programs were not very strong back then, and it wasn't really automatic like a lot of places do today. So they would most likely see something like this. But for those that did have dividends reinvested, yeah, you would get $69,516.03, which is about 1.5 times more than I bonds. But you can see how it can be comparable, and you don't have to deal with the ups and downs. Now for the Beer Money engine, iBonds will probably be the safest place to put the money you earned off of rewards apps if you are planning to save. Now granted, it's not going to convert gift cards for you, but you can either sell them for a small discount. Amazon and Walmart cards especially have extremely low discounts if you sell them from a vendor, or simply just do a one-to-one exchange from the money that you save in your checking account. For apps that pay cash, iBonds are definitely a great option just overall, and you can put in iBonds at $25 at a time, and despite what you read on the news since the mid-2000s, U.S. bonds have been amongst the safest investments to put your money in. I use iBonds as a primary dividend source in the original experiment run, and I plan to do it again when we start part 3 in January, and yes, I'll be doing one-to-one exchanges with my gift cards. So if I get a $5 Walmart gift card from, say, Cashwalk, I'm going to put aside $5 to use for an iBond, or maybe I might do something with stocks as well, but I definitely am going to start with an iBond. My plan is going to be that I'm going to just save up as much money as I can until April, possibly put it into another savings account of some sort and let it gather up interest there too, and then in April, take everything that I have and then just shove it into an iBond. So that is the video. If you want to see one of the apps I plan to use to make money on towards this, take a look at my review of Bridge Money right here, and as always, like the video if you like it, comment your thoughts on iBonds as well, and if you haven't subscribed, please do. It really does help the channel grow, and the Beer Money engine and Beer Money Network communities grow. So thank you for watching or listening, and I will see you all next time. Bye, everyone.